Hi there, I'm Paul Bagnall. Welcome to Market Call today on BNN Bloomberg. Thank you for tuning in. Gordon Reid is our guest today. He's president and CEO at Goodreid Investment Counsel. He'll take your questions, of course, on U.S. stocks. So get ready with your questions on U.S. stocks and pick up your phone and give us a call. The number is 1-855-326-6266. The email is marketcall@bnnbloomberg.ca. So we welcome your questions. Get them in. In the meantime, we'll welcome Gordon to our show and get his take on the current state of markets. Gordon, always great to see you here on Market Call.
Thank you, Paul.
Okay, you have deep expertise in U.S. stocks. U.S. indices, of course, have been punished more than the Canadian index and certainly more than European stocks on the tariff uncertainty and the economic uncertainty that it creates. What's your take?
My take is that the market is unwinding a little bit of that premium valuation that was embedded over the last couple of years as confidence grew with two excellent years in terms of performance. There was certainly a degree of fear of missing out or FOMO. So markets were propped by confidence and with the uncertainty that we now have with Trump 2.0, that's starting to dissipate. So we're seeing some of the valuations go from the low 20s to the high teens, which is more of an historical norm. So I'm not particularly worried about that. But I think anybody who's expecting that they're going to bounce right back to that premium might be disappointed. It takes a while to build confidence. And I don't think it's an unhealthy thing to see some of the air taken out of slightly inflated valuations.
That includes the big tech stocks. What has Goodreid's positioning been in the big tech stocks until now? Yeah,
that's a great question. Some time ago, I'd say about a year ago, we started to lessen our exposure to the so-called Mag 7. By the end of the year, or end of 2024, we had about a 24% exposure to that area versus 35% in the S&P 500. So quite an underweight. We think they're great businesses, but nothing grows to the sky. And we saw that expectations were getting higher and higher and higher, and decided to take some off the table, which now looks like a pretty good thing.
You've said in some recent commentary, Goodreid's confidence is tied to the functioning and adaptability of corporations over long time periods. And I think you're saying that in the context of all the economic uncertainty we've got now triggered by White House policies. Just expand on that. Tell us what you really mean there.
Well, in the last generation, U.S. corporations and corporations around the world have been quite adept at adapting to their situation. If you just look at profit margins in the United States, they peaked out at about 13.1%, I believe it was, about a year and a half ago, but they're not far off that now. Historically, they've been much less than that, which means that operators of these businesses are doing the best in the environment that they're given. So corporations have learned over the years to adapt, and there's that very, very strong push of a profit motivation. They're looking and are expected by their stakeholders to perform not only well, but well against what they did in the past, what their competition is doing, and what the market as a whole is doing. And every manager will tell you that the pressure is unrelenting. It's what have you done for me lately in this world, and they've done well.
Corporate profits can continue to grow in a tariff war environment that endures some period of time. Is that what you believe?
I do, but I think that the big question mark is, are the tariffs going to be so punishing? Is the administration going to be tone deaf to what the economy is doing and push the economy into a recession? That's one of the great worries of the market right now. I think that very likely that's not going to happen. We're all familiar with President Trump's playbook. His playbook is largely one of scare tactics, of bullying, of threats, and the market's seeing that, and a portion of the market is pulling back. I don't expect that to happen, but it certainly, Paul, is a tail risk. If we get into a recession, obviously corporate profits are going to fall for a period of time. But I think you don't want to make that your base case. But in a well-constructed portfolio, you want to have balance. And at Goodreid, 95% of our clients have that balance that hedges somewhat against tail risk.
That is Gordon Reid. He's our guest. He will take your questions on U.S. stocks right after this. This is Market Call. Our guest is Gordon Reid. U.S. stocks are the focus. And our first question comes by way of the email inbox. Ash in Stratford, Ontario, writes on the subject of Dell, ticker symbol DELL in New York. What are your thoughts on Dell? Do you own it or any of its competitors? Is it a good time to buy it?
We don't own it. Obviously, Dell is a hardware company. And I think last summer, with all of the buzz around AI, it spiked up, I think, around $180, and it's close to half of that right now. The balloon is a bit off the rose in terms of the AI adoption, how it's going to evolve, and how various companies are going to benefit or not. And I think when you look at hardware companies, historically, they haven't had a lot of stickiness simply because the real opportunity is more in the software side, the adaptability side. So hardware companies tend to trade at lower multiples because it's more transactional.
Okay. Thanks, Ash, for your question on Dell. Let's go to the phones and John, who is in London, Ontario. John, thank you for your call.
You're welcome, Paul. Hello, Gordon. The voice
Hi,
of
John.
reason in an emotional market. Gordon, I'm a longtime holder of Google, and it's done well until recently.
Yeah.
Its valuation is looking better and better, and we just found out today that it bought the cybersecurity company Wiz. Mm-hmm. What do you think of good Google for an ad and a long-term hold? Thanks very much.
Yeah, John, I think that if you look at comparatives, Google against any of the Mag 7 or any of the tech stocks, you'll see that there's a very similar price action. So I wouldn't be too worried about it being idiosyncratic. Google's a great company, trades at a very reasonable valuation when compared to its growth rate. And I think if, as a long-term investor, you want to get involved. You might strategize and buy half, see whether it continues to go lower with this market correction. But in the end, you want to get a full position sooner rather than later. As far as the acquisition they made, there's going to be a lot talked about and written about on that. It's probably the first big test of the new administration's policy on antitrust. So that'll be extremely interesting to watch. And a very big price tag, $32 billion. I think last year they were offering $23 billion. So you could throw billions around pretty easily in that market, I guess.
Thanks for the question, John. Let's go to Chilliwack, BC. Andre's on the line. Hi, Andre.
Oh, good morning, Paul. Thank you for taking my call. Gordon, thank you for coming in. Always great to see you. Could I please get your thoughts on Eaton Corporation? I know it's sold off $100. Mm-hmm. Is it becoming more bullish to you? I know Goodreid's looking at it. It's probably on the watch list. Could you just maybe update me on an Eaton Corp? Thanks, Gordon.
Sure, Andre. Thank you. You're bang on as usual. We owned Eaton and did very, very well for our clients with that holding, but it hit somewhere around a 33, 34 multiple against earnings, and it was just a little too rich for us given its fundamentals. So we sold it. It continued higher, which isn't, of course, a surprise because, of course, things often drive higher or lower on momentum as opposed to fundamentals. But ultimately, they find fair value, and we've seen it sell off dramatically, perhaps more than other companies in the area because of the high valuation. So as you said, we are looking at it. I spent some time on it, in fact, yesterday, and it's still a very good company involved in the data center expansion with their electrical division. And I think there's a lot of growth there. I'd like to pay a little less for it, to be honest with you, but we are watching it.
Okay. Eaton Company is a maker of engineered products for several industrial sectors. Let's go to Anne in Scarborough. Anne, thank you very much for your call. What's your question to Gordon Reid?
Good afternoon, gentlemen. Gordon, I'd like your thoughts on Cisco Systems going forward. Thank you.
Thank you.
Sure, Anne. Cisco is maybe just like a foundational or a cornerstone company in tech. A lot of switches and hardware. They have worked very hard to increase their relevance, but there's tremendous competition in the tech area, and Cisco has always kind of been one step behind in the latest iteration of their development, and I think they continue to be perhaps one step behind. So I think there's better opportunities in tech, and I've talked about a couple of them so far, but we'll, I'm sure, talk about more.
Okay. Thanks, Anne, for your question. Thanks to that first batch of questioners to Gordon Reid. We'll be back with Gordon after this. He's president and CEO at Goodreid Investment Counsel. U.S. stocks are his area of expertise, and he'll take your questions again right after this.
Making sense of business and the economy can be tough. We dig through the details to tell you what you need to know with straight talk and expert analysis so you can make informed decisions about your future.
Taking Stock, Fridays on BNN Bloomberg.
Renovated. Welcome back to Market Call. Rob in Calgary is our next caller, and Rob is on the line right now. Rob, thank you for your call. What's your question to Gordon Reid?
Hi, thanks for taking my call. I'd like to hear Gordon's opinion on Pfizer. Since the post-COVID fall in the stock price, it looks like it's been bottoming out and trading in a bit of a range. Gordon, do you feel that there's a catalyst that may get this stock moving, or do you think that there's better alternatives in the big pharma space? Thanks again, and have a good afternoon.
Yeah, Rob, I've looked at Pfizer. It looks inexpensive, of course it is, but as they say, it's cheap for a reason. And when I look at Pfizer, I just don't see any growth. They made a big acquisition in CGen not that long ago. If my memory's correct, it was over $10 billion, and it just didn't impact. They didn't get really any growth out of it. And when I look out 5 years, for example, I just don't see a lot of growth metrics there. So I would point you towards perhaps Merck or Amgen as somewhat growthier, a little bit more expensive, but not materially more expensive, but with growth opportunities. So that's probably where I would head.
Okay, thanks, Rob, for your question on Pfizer. Let's go to Ross in Windsor, Ontario. Hi, Ross.
Hi there. Great show. Thanks for taking my call. I'd like Gordon's opinion on Berkshire Hathaway, the Class B, I guess. It's been doing pretty good while the rest of the market's been going down, and they've got quite a large stockpile of cash on hand. So I'd like Gordon's opinion on that, if it could. Thanks.
Yeah, one would expect it would do fairly well in this environment because of that cash hoard and also because of the reputation that they have. They've built the cash up by selling some of their name holdings, in particular Bank of America and some Apple. But of course, you have to take the whole picture, and you have to look at how they did in 2024 and 2023, and they trailed because they were building cash. So it's a two-edged sword. I think they are adept. I think, of course, as we said off the top of the show, if we do hit that tail risk and there is a recession, which would drive the market lower, they're going to look very good. If this is a garden variety correction and we come out the other side and move back towards new highs, we'll see what they do with the cash. I would expect that there's more to the story. I don't think it's all a market timing situation. I think He's probably got 1 or 2 targets in his sights, and we'll just have to wait and see.
Thanks, Ross, for your question on Berkshire Hathaway. Let's go to Paul. Paul's right here in Toronto. Hi, Paul.
Yes, hi, sir. Good afternoon. I just like to know about NVIDIA. I wanted to enter, to buy some stocks of NVIDIA. So what is a good price point for that, please? And thank you so much.
That's a really tough question, Paul. And the reason it's a tough question is that chip stocks, by their very nature, are highly cyclical. And if one relies on fundamental expectations, so earnings expectations, to dictate a price to get in because they represent good value, you might get yourself into trouble because they are cyclical. So that earnings expectation just might dissipate. It might fall apart. And I think if you have watched me on the show over the last 6 months or so, when I get calls on NVIDIA, even prior to the end of 2024, when it was basically a rocket ship going straight up, I was very cautious. And the reason I was cautious was because it was very expensive on a valuation basis, and the future was somewhat cloudy. What is the evolution of AI and AI chips? We're now starting to see some question on that. Is data center development going to continue as it has? Is all of the money that's been invested in the data center perhaps an overreach? With chips, historically, we've seen a tendency to front load for customers to buy up because there's a shortage. And then when things slow down, the inventory channel gets stuffed. And the producer of the chip is dead in the water. And we've seen that many, many times. I don't know that that's going to happen to NVIDIA, but I hesitate to pay a price for it. So we're on the sidelines.
Okay. Thanks, Paul, for your question on NVIDIA. Let's go back to the email inbox. Rick has written us a message. Subject here, Danaher, DHR on the New York Stock Exchange. Can I get your opinion on Danaher?
It's an expensive stock at 27, 28 times earnings with tepid revenue growth. They talked on their last conference call about cost-cutting efforts, which is on one hand encouraging because, of course, that enhances profit growth. But on the other hand, if you feel you have to talk about cost-cutting to make up for fundamental weakness in revenue growth, which is the engine of profits, that's a red flag. So at 28 times earnings, I would definitely pass here.
Okay. The company makes testing and measurement equipment and sells it to the medical, industrial, and other sectors. We will take a quick break. When we come back, it will be time to revisit Gordon Reid's past picks. That's next. Time now for Past Picks, where we go back in time and revisit our guest picks from an earlier edition of Market Call. We're going back almost exactly 1 year now to March 13th, 2024. One of Gordon's top picks on that day, the big copper producer, Freeport-McMoRan, FCX in New York. There you see the numbers, total return over that period of time, negative 7%. Gordon?
Yeah, it's interesting. We've gone through a year where the China reemergence has not happened. They're making another attempt at it now. EV adoption has slowed, and electrification has, as a whole, kind of slowed. But it's going to happen, and it's just a matter of adoption and getting all of the levers to work at the same time. Interestingly, copper spot price is up, what, 25%? This quarter?
It was $5 this morning. We should check in on copper. It has rallied in a big way. Viewers will certainly see this, the shape of the copper graph and the gain it's made recently. There it is, very sharply, right at the beginning of this year, the rally really began. Go ahead, Gordon.
So given the fact that if you overlay Freeport on that copper chart, you'll see that this year, from the beginning of 2025 to date, copper's basically flat. yet you've seen copper spot go up 25%. What I see from that is that Freeport's going to have a pretty darn good quarter, given how levered they are to copper prices, and the market's not anticipating that. Why? Probably because of fear of tariffs and what they're going to mean to copper prices. Is copper going to be a protected mineral, as some are, and I think they're petitioning the White House or the administration for that? Are there going to be tariffs on foreign production of copper, specifically China? We just don't know the answers, and until some of these unknowns dissipate, you can guess, but you don't know. We think long term the secular tailwinds are very much intact. Copper's projected to, or copper usage is projected to double over the next 7 years, which is a very rapid rate of almost 10% annually. So, there's good reasons to like copper. It's not something that you can just instantly start producing more. It's a very expensive and long-dated project to get copper out of the ground. Freeport's in a great position. We like copper to the point where in our Canadian portfolios, we've recently added Teck, which is now almost exclusively a copper producer now that they've gotten rid of their coal assets. So we like copper very much.
Okay. That was the first top pick on those days. These are not ranked in terms of preference, just the sequence that Gordon presented them to us on that day. Number 2 on that day, IBM, ticker symbol IBM in New York. Total return here, 30% over the roughly 1 year period of time.
And my argument back then was that IBM wasn't appreciated as an AI play, that they had, through their Watson X capability, through Red Hat that they acquired some years ago, and through their association with Meta using OpenAI and Llama 2, that IBM was an AI opportunity. In our period of time that we owned it, was recognized. As you can see, it shot up, and we sold it in around the $235 range, I believe it was, simply because on recognition, the multiple rose quite considerably. Its value dropped. We didn't see on an earnings basis it really matching that trajectory. So we decided to exit with a very nice profit.
Okay. Let's go to the final top pick on that day, Meta Platforms, META in New York, on the NASDAQ. Total return here, 17%.
Yeah, Meta's nicely priced, trades at about 23 or 24 times earnings. Growth rates are exceptional. 3.2 or 3.3 billion daily active users, so 1 in 2 humans on the planet have some interaction with a Facebook or a Meta product, and they've got a variety of different products that hedges their portfolio. So we think it's an excellent place to be and continue to own it. Okay.
Those are Gordon Reid's past picks from March 13th of 2024. We'll be back with Gordon after this. He's Chief Executive Officer at Goodreid Investment Counsel. He'll resume taking your questions on U.S. equities right after this. Okay, let's keep the questions coming to Gordon Reid. This is Market Call on BNN Bloomberg. Fred is in Guelph. Fred, thanks a lot for your call.
Yeah, good morning, guys. See, this tariff thing has got me, Gordon. I finally figured out that the importing country that pays the tariffs, like the United States in 1857, Bethlehem Steel was the largest producer of steel in the world until their demise in 2003. During the Second World War, they built and manufactured over 1,100 warships. I can see if there's a product that's built in both countries and one country decides to put a 20% discount on it. Sure, put a 20% discount on it, but it's going to be the American citizens that are going to be paying for this tariff tax. And I was wondering if you could explain that. Thanks. Have a good.
Well, Fred, you just did. You're right. The receiving country pays the tariff. If there's a 20% tariff put on Canadian products and they go to the States, product costs 20% more. Whether the company chooses to absorb that or pass it on to their customers is up to them, but it's definitely in their court. It is a confusing area, and maybe to help you out, we one of our very recent hires in the investment management area at Goodreid is Julian Nono Wandum, and he wrote a great article on tariffs that's on our website. If you go to goodreid.com, go to Insights and Articles, and then just sign up with your email address, and you'll have access to all of our articles. But look for the one on tariffs, and I think you'll learn a lot from it. It's quite insightful, and I think gives you a good perspective, not only from an economic standpoint, but from an investment standpoint. So I'll leave you to that.
Okay, good stuff. Let's go to Sal in Toronto. Sal, thank you very much for your call.
Hi, thanks. Yeah, my question is on Booking Holdings. You just recently had a pretty good earnings report, it seems. I think the kind of downfall right now is probably the whole general market sentiment and whatnot. So what I was wondering is this a good time to take a position in, or is it better to wait a bit and see the sentiment sort of improve before jumping in? Thanks so much.
Yeah, well, Sal, we own Booking in our U.S. large cap portfolio, and this is a fantastic company. It grows at a very aggressive or fast pace, yet it doesn't have a challenging valuation. It trades somewhere around 18 to 20 times earnings, if I'm not mistaken. So we just love these types of companies. It's a low capital, high, a tech entry into the travel business. And they are very innovative. They're very smart managers. They're well diversified geographically. Booking.com is the sort of the cornerstone franchise of the whole company. And their success was really built in Europe by offering all of the hotels in Europe that are mom and pop type hotels who have no voice. They have no way of really reaching out. And the Booking model allowed them to create that voice and a conduit to a sales opportunity. Hugely successful for them. So we would very much encourage people to buy Booking. Believe it or not, Paul, our first entry to Booking goes back almost 30 years.
Wow. What was it called back then?
It was called Priceline.
Right.
And Priceline.com, and we bought it for $19. And that's not a typo. The stock right now is where is it?
Let me find it.
Yeah.
We can put it up on the screen. Booking.com.
Yeah, BKNG.
There
we
is.
are, $4,470.
$19.
And we first bought it at $19 almost 30 years ago. Now we've owned it and sold it and owned it and sold it a couple of times, but we've made a tremendous profit on it over the time.
Wow. Okay, thanks for the call, Sal, on Booking Holdings. David is in Toronto. David, thanks for waiting on the line. I know you've been waiting for a bit. You're on the air now with Gordon Reid. What's your question?
Thank you. Good afternoon, gentlemen. I'm David from Toronto. I have a question on Ford Motor Company, which is going nowhere. The pricing appears to be okay. They've good dividend-paying stock. How do you compare this to other companies like General Motors or Stellantis?
Mm-hmm. Yeah, we don't own Ford. We do own GM, and I'm going to be talking about GM more extensively in a little while. One of the reasons that we own GM is we think that they are very, very well managed, perhaps better managed than some of the other companies in this area. Mary Barra is the CEO at GM. They have a higher margin than their competition, which encourages us. They spin off a lot of cash. I'm talking about GM now, and they're very, very inexpensive. They've got a $60 or $55 billion market cap, yet they've got a $10 billion buyback authorization. So almost 20%, say 18% of their total outstanding shares are covered in their buyback authorization.
This is GM.
This is GM.
Okay,
So there's a lot of cash being produced here. Ford doesn't have those advantages. So we always do peer group analysis, Paul, when we look at companies, and you have to look at the sectors and the industries, because you might find a really good company, and think it's a really good company, but what you've really found is a fantastic industry or sector, and what you're looking at might be number 3 or number 4 in that sector.
Right.
So you have to be careful of that. We've done that. We think GM is a great opportunity.
Okay. That is Gordon Reid and taking a question on Ford. And again, he'll have more to say on GM later in the show during his top pick segment. We'll be back with Gordon right after this. He will continue taking your questions on U.S. stocks. Okay, let's keep the questions coming to Gordon Reid, at least for one more segment. Ramit is in Toronto, and he's up next. Ramit, thank you for your call.
Hi, good afternoon, gentlemen. Thank you for taking the call. Gordon, would love to get your thoughts on Uber as a long-term investment, especially given the change in the landscape with the emerging offer. So what would you like Uber to do and see, and what do you think is the target price? Thank you.
Mm-hmm. Thanks, Ramit. We are owners of Uber in our U.S. large cap portfolio. We think there's tremendous opportunity here. It's being held back somewhat by what we think is a misconception about the whole industry, and that is that ride sharing or autonomous driving is going to be a dislocating event for Uber, that it's a sort of a binary thing. If autonomous driving takes hold, Uber's out of business, and if it doesn't, Uber does great. We think that's really not the way to look at it. They've already got partnerships with Waymo, which is Google's entry into the autonomous driving space. They will participate one way or another, and they are a great operator. So we own them. We think that they're undervalued because of that misconception. So we would buy them here, and they would be a cornerstone of any portfolio for a long time out. They've got 4 basic divisions. Of course, we're all familiar with the mobility. Some of us are familiar with Uber Eats. And of course, they've got their advertising side that they really haven't monetized. But they've got 160 or 170 million apps that are loaded down on devices that gives them a great audience, and that's of great value. They haven't monetized that yet. And then they've got freight, which I think probably will be jettisoned at some point in the future. I don't think that's really going to, in the long term, be a core area for them. But the rest of it is gold.
Okay. Thanks, Ramit, for your question on Uber. Let's go to Anita in Markham, Ontario. Anita, what's your question to Gordon?
Good afternoon, gentlemen. Thank you for taking my call. Gordon, my question is on Griffin Corporation. You had recommended this some time back, and I did extremely well initially, but I guess with the market condition as it is right now, it's come down. So my question to you is whether I should take the profit and run, or do you still see growth in this company? Should I hold on to it? I'll hang up and listen to you. Thank you so much.
Yeah, thanks, Anita. We still own Griffin. It is somewhat interest rate sensitive because they're sort of a second derivative to the housing market. They make garage door openers and, not openers, garage doors and the like. And, if the housing market freezes up, as it has because of interest rates and mortgage rates over 7%, although they've dipped down now below 7% for a number of weeks. But the housing market is a bit frozen. That's going to freeze a company like Griffin. So I think as a long-term holder, you just wait until a more favorable environment. If you believe that interest rates are going to be persistently high, which means that you're probably a believer in more versus less inflation, then you'd want to sell Griffin. We're not a believer in that. We think that the powers that be really want to bring interest rates down. We think they're attacking the hawkish side of that economic impulse, and that the housing market will thaw up. And Griffin will be a good place to be.
Okay. Thanks, Anita, for your question on Griffin. Let's go to Calgary. Ken is on the line. Ken, thank you for your call.
Yes, thanks for taking my call. I've got one question. I've held Costco and Microsoft and my kids' RESPs for several years, and they've done really well. I'm just wondering, do I get out now and take advantage of the free drinks back in the Canadian market? Do I stay and look at the opportunities to invest, or like, I'm not quite sure what to do here.
Yeah, we do own Microsoft. We think that it's well priced here. We think it's going to be a participant in, and is a participant in AI, and it has a broad portfolio. Costco is a great operator, and this is a fantastic example of the difference between a great company and a great stock. Costco has done everything as a company. It's got a fantastic model where virtually all of its profits are covered by the membership fees, and they can sort of play off the low margin, high volume business that they have with their stores. So it's a great model, but it trades at, even with the drop down, somewhere in the low to mid 40 multiples. As a retailer, that's just excessive. It's just too high because they're capped. I mean, unlike a technology company where, if you have the right products and you hit the right timing, you can grow at fantastic rates. But a retailer's a retailer. You're capped. You're only going to grow so fast. And to put a price tag of 40 or 45 times earnings on it really limits your opportunity and presents more downside risk than upside opportunity. So it's what we would call an asymmetric situation. So I would probably sell out of the Costco, Ken, and get into something that's longer term. I just talked about Uber. I think that would be a great company.
We're running out of time. The age of his kids is important here too, right? Because these are held in an RESP. Any very quick thoughts on age of children and RESPs?
Well, I mean, yeah. I mean, that's a good point. You have to be somewhat sensitive if your trigger point is soon. But I'll leave that to Ken. But it's a great point, Paul. You do have to be sensitive to asset allocation based on the vehicle that you're putting it in. But as a long-term investment, I think Uber is a very good choice.
Okay, let's squeeze in one more call from Joe in Montreal. Hi, Joe. Thanks for waiting.
Yes, thank you, Paul. I want to ask your guest about Bank of America. It's taken quite a dip in the last few weeks, and I have this many years. Should I take some profits now, especially with the exchange rate, or does he think it's going to go back up? Thank you.
Well, we own it in our U.S. large cap portfolio. It is a good holding on a valuation basis, so it trades at a discount to its historical valuations. The setup for money center banks is good right now. The yield curve is steepening with all of the fluctuations and the trading and the volatility in the market. These enterprises are going to show very strong trading revenues and profits in their next report. So I think it's a good place to be.
Joe, thank you for your call on Bank of Montreal. And Joe is our last caller and questioner. That's all the time we have for questions today. Thank you to everybody who took the time to ask a question. Gordon Reid's top picks are right around the corner. Welcome back. It's now time for top picks from our guest on Market Call, Gordon Reid. Number one on this day, and again, not in terms of preference, but just in terms of sequence, Citigroup, ticker symbol C in New York, one of those big money center banks you were talking about.
Yes, and you can create a package, and that would include Citi in our way of thinking. We own Bank of America, as we talked about. We also own JP Morgan. We own Morgan Stanley. We like this group very, very much. As I mentioned, the yield curve is steepening. We think the economic situation is becoming more favorable to the banks. We've got a regulatory backdrop which is much more favorable to the banks. A lot of the post-financial crisis safeguards have built up tremendous capital in these banks, which is now starting to be released because it's loosening up on a regulatory standpoint. So we very much like Citigroup. It trades at a discount to its tangible book value, about a 24% discount to tangible book value. And we think that valuation discount will start to compress. So it'll start to be priced more like its big brothers. Citigroup has been in the doghouse from past experiences, but it's under Jane Fraser, the CEO, very quickly coming out of that doghouse.
Okay. And we had some prior discussion on this one, but we'll dig back into it. General Motors, ticker symbol GM in New York.
Yeah, it's all about tariffs. I think one way to try to understand what might happen in this tariff discussion is to look at the companies that are affected. So if you believe that the tariff situation was going to be very damaging to companies like GM, you wouldn't see a chart like that. GM chart pricing is telling you that there's an escape hatch here and that they're going to come out the other side of it. On a valuation basis, they're very inexpensive. They trade at 6.8 times enterprise value to EBITDA, which is very inexpensive. They're a cash flow machine. As I mentioned earlier, about 20% of their total market cap is in a buyback authorization. They've just recently increased their dividend, which is something that gives you a lot of confidence, and well managed. We think they're the best of breed.
How important is success in the EV market for GM?
They've done a nice pivot. They had dedicated a lot of their resources and their CapEx to the EV side, only to see, as the whole industry saw, the adoption rates really slow down. I think a lot of it had to do with the levers not moving at the same pace, battery technology not being as advanced as some other parts of the EV revolution, and customers just saying, I don't want to stand and charge my vehicle for 20 minutes. Yeah. I want to pump gas for 3 minutes. Yeah. But it's coming, Paul. We all know that. More and more we're seeing EVs on the road. It's coming, and they do have a good foothold. It's just they've pared it back, and when we start to see the adoption rate increase, they'll be right there.
Okay. And the third one is a lesser-known stock, I think, to most viewers, StoneX Group, which is a financial services player in a particular niche of that market. Go ahead on StoneX.
StoneX is, think of a cross-border global trading vehicle for commercial, institutional, corporate operations. They do hedging operations. They do currency. They do options. So any complex trading need can be accomplished through an account with StoneX. Right now, we see a lot of volatility in the market, so they're very, very busy, and a lot of people doing a lot of business because of the volatility in the market. They trade at only 9 times earnings. They're about a $3.5 billion market cap company. But a very profitable company. Their ROEs in the last report are pushing up towards 20%. So a very, very well-managed company. So we particularly like them.
Gordon, on behalf of our viewers, thanks again for another edition of Market Call in the books.
Thanks, Paul.
Gordon Reid, our guest, expert in U.S. stocks. Lots to say on that subject. Thanks to Gordon. Thanks in particular to everybody who took the time to ask a question. If you didn't get through, please call us again here on Market Call. Let's take a quick look at markets before we go. The S&P TSX Composite, the S&P 500 and the NASDAQ Composite down again. So the year-to-date declines deepen in the United States. The NASDAQ is now down 9.4% on a year-to-date basis. It's well into correction territory measured from its peak. The S&P 500 also down, and there's the TSX Composite. The TSX Composite is basically break even for 2025 so far. We should take a look at gold, because gold has traded into record high territory through the day today. There is basically, give or take, $3 or $4, the highest price ever on gold in the actively traded contract, which is the April contract right now, $3,044 per ounce. Let's take a look at Agnico Eagle Mines, AEM, and see how it's perhaps reacting to today's trade in gold. It is one of the flagship TSX stocks. There it comes, up by 1.25% to its highest level in more than a year. Thank you so much for watching Market Call. We'll see you next time. Tomorrow, Brianne Gardner's on the show. In the meantime, we'll turn things over to Andrew Bell and Trading Day here on BNN Bloomberg.